Uh, Good day, ladies and gentlemen. Welcome to LeaderX. The JSE is proud to be sponsoring this session today. I hope you're all enjoying your time here and have been in a number of exhibition areas and stalls. So we are bringing you the JSE Stocks Picks here. I will just briefly hand over to the investment professionals and the analysts here that we've invited to briefly introduce themselves. I've already asked them to mention one thing that they found interesting or curious about LeaderX. Formally, my name is Langa Mangaile. I am the head of equity and equity derivatives at the JSE, and we are coming to you live at Sentin Convention City here in Johannesburg. We'd also like to welcome all the viewers who are catching up with us online, whether it's YouTube or wherever streaming service that you may be joining us from. So the session will be 50 minutes long. At some point, we will open up the floor for the opportunity to the audience to take questions. I'll just want to ask ahead of time that you only ask a question. First, you raise your hand, briefly introduce yourself, go straight to the question, and only ask the question when you have the mic with you on hand. I will start on my just far left for Petra to introduce himself, come to Nerina, and then with Chantal.
Okay, thank you very much, firstly, for the introduction. And again, thank you to the JSE for having us today. So my name is Peter Redlinghuis. Almost a decade ago, I started a company called Herenia Capital Advisors. We are a stockbroking firm and a very small asset manager. We do some portfolio management for clients. And we have a variety of different trading accounts for retail traders. We tend to cater to the more serious trading sort of segment of the market. I think there's a lot of guys out there doing Forex trading and that kind of stuff. We're not really in that space as much as we are in really just on exchange, semi-professional to professional traders. I don't really have much else to say. My personal background, I've been in markets for almost 20 years, I guess, running my own business for the last 8. That's my story. Nerina?
Thank you, Petri, and thank you, Langa, and thank you to the JSE for this opportunity. My name is Nerina Visser. I'm a director at the ETFSA Portfolio Management Company. We specialize in exchange-traded products, and so it's going to come as no surprise to you today that I'm not going to be picking any stocks. I'm actually going to be picking some ETFs and some other interesting and unusual exchange-traded products. So we offer for individuals the ability to do your own trading in all of the over 200 exchange-traded products that are available on the JSE, but we are also registered financial advisors. So unlike many other trading platforms, we are actually authorized and able to assist investors with choosing specific investments, giving them advice on it, helping you with financial planning, and so on. We use exchange-traded products also in a variety of different things. It's not just in discretionary and tax-free investment accounts, but also retirement annuities, living annuities, and so on. So think of the ETF just as you would think about shares in an individual company, but instead of buying a single company, you're actually buying a whole basket or a whole portfolio of investments, much like unit trusts, but you buy them on the JSE. So, thank you. That's me.
Hi, I'm Chantal Marks. I head up research and content at FNB Wealth and Investments. At FNB Wealth and Investments, we offer a range of services from direct trading for yourself to a fully serviced offering from a stockbroking perspective, wealth management, portfolio management. I think most of you guys would be familiar with FNB and that offering, but I would motivate you to go and look a little bit deeper at FNB stockbroking and portfolio management. The biggest thing there is that we offer a full range of research for retail clients, which is really cool and a key differentiator. What I love about LeaderX, I don't want to miss your question.
Oh, yes.
So it's just been really great for me to see all of these people in one space. I haven't been to the convention center since, I think, Winex about 5 years ago. And this is definitely a different slant, but it is just awesome to be around people again and to feel that energy.
Thank you very much. Thank you for that introduction. So we will kick off with you, Chantal, just right off to please give us an investment case of your 3 stocks picks that you've picked up. just briefly. You can go through them sequentially. It's up to you. Then we will kick off from there. So over to you.
Okay, so just as a start, I am a boring long-term investor. I pick stuff that I'm willing to hold for the next 10 or 15 years. I don't have to look at it every day. I really like companies with super stable management teams, a big addressable or big and growing addressable market, and with strong balance sheets and strong underlying fundamentals. I do dabble a little bit on the technical side, so I usually try and combine the two to also look for trading opportunities or entry opportunities in stocks that I really love from a fundamental perspective. So expect boring, expect cheap, and expect companies that you can get into at reasonable technical levels as well as reasonable prices. So my first pick is the most boring of them all, and that is Mr. Price. Most South Africans are very familiar with Mr. Price and the Mr. Price stable. So it's the Mr. Price Apparel, Mr. Price Home, Sheet Street. They now own Yuppie Chef, a company called Power Fashions, which is more in the value and discount segment of the market, as well as more recently Studio 88, so where you buy your really cool sneakers that you spend a whole lot of money on. I have a bit of an obsession myself with sneakers, so I frequent them quite often. But Mr. Price's share price has been under a lot of pressure over the last year or so, in part because interest rates have gone up, inflation has been high, so consumer disposable income has been under pressure. Mr. Price is also not exposed to credit, which means that when people start taking up store credit, Mr. Price isn't a natural place where you would get store credit. They're also very strict on that. But I think with the interest rate cycle probably turning in the next 6 to 9 months and inflation coming down, there will be some really decent support for Mr. Price from a top-line perspective. I think they can expand margins because of the integration of these new businesses that is gaining traction. And a very interesting thing, one of their big competitors at the moment is Shein, right? A lot of people now, when they're tech-savvy, they're buying their clothes directly from China. Yeah. But SARS has taken notice. And I think it's going to become a lot more expensive to buy clothes on Shein. So I think some of those market share losses could be reversed. The share's trading on a forward PE of about 9.5 times, relative to an average over time of about 14, 15 times. So it looks quite cheaply valued. Technically, we also like the company currently. My second pick, I'm going to chase through the next ones. This is a company firmly in that small to mid-cap space. It's called Master Drilling. They drill big holes in the ground. That is what they do. They build these drills in Fochville in the northwest, where they are still headquartered and managed by the founder. So this company has a very rich, long history of drilling big holes, but they now not only do that in South Africa, they do that globally. Now, we think that there's been a massive underinvestment in mining over the last 10 to 15 years. A lot of it has to do with a lot of mining companies almost going under around about 2016 because they spent too much money. But we need metals, particularly metals of the future like copper and zinc, in order for the digital revolution and the clean energy revolution to continue. So we think there's going to be a big spike in mining capex over the next 10 to 15 years, and Master Drilling, with its unique technology and proven technology, is set to benefit from it. Trading on a 3.5 times forward PE, so a very cheap one at that. And then my final pick is Raubex. So Raubex, they build roads and they sell materials that other companies use to build roads as well. We know that one of the only areas where government has been actively growing its expenditure over the last year or two has been in roads infrastructure. Sunroll is putting a lot of tenders out to market, and Raubex is winning a lot of those tenders, or at least in some instance being subcontracted. Even the ones that they're not winning, they're supplying the materials to actually build those roads or repair those roads. Tender activity has been very robust. The margins at which they are writing business is quite solid. Very strong management team. and tends to do quite well within the broader construction space when we see a pickup in fixed investment expenditure. Raubex is trading on a forward P of about 5 times, so another very cheap one within that mid-cap space. And my last pick for the day.
Oh, thank you very much. So there you have it. We have a retailer pick there. We've got a construction and some mining services. Just one question I'll put before I jump on to Nerina. You keep referring to a forward PE. I don't want to take it as given that everyone understands. If you could just explain that, maybe break it down a little bit.
Yes, so a price to earnings ratio is the company's price, and then that's divided by its earnings. A forward PE is the price divided by next year's earnings. So what we look at here is basically how long it's going to take the company to pay you back for your investment. The lower a PE is, the cheaper a stock is, and the shorter it will take the company to pay you back. The higher a PE, the more expensive a company. Now, we have different companies trading at different PE levels for different reasons. So I usually like to look at a company's PE relative to where it was in the past. And if it's much lower than it used to be, that stock looks cheaply valued. If it's much higher than it used to be, it looks expensive. It's not a perfect science. There's a lot of other stuff that you need to look at, but it's a really nice, quick and dirty way of assessing whether or not a company is worth a second look.
Thank you, Chantal. I will let the audience digest your picks in the meantime. Let's move over to Nerina. Over to you, Nerina.
Thank you, Langa. So much like Chantal, I'm also into long-term investing rather than short-term speculative trading. And my first pick today really represents the investment for me that if I only ever had to make one investment and never look at it again, this would be the ETF that I would buy. It's the 10X Total World ETF with a very aptly named code of global. So if you're going to buy this thing in your stockbroking portfolio, the code that you will be using is global. This global ETF invests into an index tracker fund, and the index covers over 9,000 companies globally. They cover both developed and emerging markets, and it covers large cap, mid cap, and small cap stocks. So truly the most diversified exposure of equity exposure globally that you can get. And you can buy it right here on the JSE. So this is a little bit like buying my favorite Belgian chocolate in my local Spar. I like the best of both worlds. Some of the benefits for me of this type of index tracker fund is that the index effectively accommodates shifts in the global investment landscape. So as emerging markets grow over time, so the prominence or the size of the exposure of the emerging markets in this index will be reflected. So you as the investor don't have to sit there and think, ooh, should it be developed markets, should it be emerging markets? The index effectively does that for you. The underlying investment of this 10X ETF is actually the Vanguard Total World ETF. Now, Vanguard, for those of you that don't know, is the company that was founded by Jack Bogle, the father of index investing. And certainly this is one of the largest, most liquid and most cost-efficient ETFs available in the world. But with 10X bringing that investment opportunity for you to the JSE, you're able to buy it here at a very, very attractive rate. Total expense ratio of 0.29%. Do you know that when you buy individual shares on the JSE, there is an STT, a securities transfer tax that you have to pay? It doesn't go to the JSE, it goes to SARS. It's a 0.25% tax that you cannot avoid. It's like VAT, you just have to pay it. So for not much more than the STT, you can buy this ETF at 0.29% total expense ratio, and you don't pay STT when you buy an ETF. So certainly a great value proposition from that perspective also. This ETF also declares dividends twice a year, so much like many of your stocks, and you will actually receive a dividend payment. And I guess for retail investors, one of the most important benefits of this type of investment is that this does not count as part of your offshore allowance. So you don't have to make use of the 1 million rand single discretionary allowance or your 10 million rand further allowance. You can buy this on the JSE without having to make any use of those allowances. So that's global. What about South Africa? Because there certainly are some great investment opportunities locally also. So my second pick for today, many of you might be familiar with the Satrix 40. It was the first ETF. And I see lots of you taking notes. That's not my second pick, so you're going to have to scratch out what you've just written down. Satrix 40 was the first ETF to list on the JSE back in the year 2000. Now, we're very familiar with that also because it gives you exposure to the top 40 companies on the JSE. But there's so much more than the top 40. And if we look at what makes up the top 40 companies, these are very global and international companies. And if I've already got my global coverage through my first stock pick, then I would rather go for the Satrix Capped All Share ETF. Now you can write down. So this one actually gives you also, in addition to the top 40 shares, you also get exposure to the mid and small cap shares on the JSE. And in fact, the only ETF on the JSE that will give you exposure to JSE listed mid and small cap shares. Why the benefit of bringing these smaller cap companies into the equation as well? We know that there's certainly lots of evidence that mid and small cap shares over longer terms provide better returns than your large cap stocks. There are short periods of time that large cap and top 40 will outperform, but mid and small caps typically is where you get additional value. But they could be quite risky individually. So it's difficult to understand unless you've got experts like Petri and Chantal that tells you which of those mid and small cap stocks to pick. It's quite difficult to know. By having this basket of mid and small cap stocks that also trade quite differently, you get very good diversification. You get a risk reduction because of having exposure to over 120 shares on the JSE, again, with a single investment that you make into the Satrix Capped All Share ETF. My final pick is something totally different. We're talking here about stocks, about shares, buying equities. But we also know that in a very well-diversified portfolio, we also want to get exposure to other asset classes. Now, the South African economy and the JSE was built on the gold mining industry. It was built on the physical commodities that we mine and have so much of in this country. And physical commodities is a great diversifier in a portfolio. Yes, we can buy shares in mining companies, but that's quite different than actually buying the physical underlying commodity itself. But here's the trick. Commodities are something that actually doesn't pay you a dividend, and it doesn't have an upward sloping trend line than the share prices of a company would often have. These things are cyclical. I mean, we only have to look at things like the gold price and the oil price and so on to know exactly how cyclical the prices of a commodity can be. And so the Coherent Capital Global Commodity AMC, Actively Managed Certificate, I know that's a huge mouthful, so it's share code CCMGCZ. That is an investment that gives you exposure to a whole basket of commodities. And it's actively managed. Because what you need with physical commodity exposure is somebody that actually understands the gyrations, the cyclicality of these commodity prices, when to be long of something and when not to own something. Also, it covers a very broad spectrum of commodities. Commodities are so much more than just gold or our platinum PGMs and so on. So certainly we're very familiar with our industrial metals and our precious metals, but that's just one type of physical commodity. The energy spectrum is where you're going to find oil, natural gas, coal, these sort of commodities. And then there's also agricultural commodities. And this could range anything from maize and wheat and sunflowers and so on to things like cattle and cocoa. So why would you want to have an exposure to a commodity basket? Well, first and foremost, it's the diversification across those three broad classes of types of commodities. But then within each of those groupings also, there are some commodity components that do much better than others. If I look currently at the commodity spectrum, for example, things like cattle and cocoa are currently doing really well. Wheat, despite what's happening in Russia and the ban there, is actually doing quite poorly. So you need that specialist manager that can actually manage this exposure for you. I like the description also that I read in terms of this type of investment, that this investment is like an elegant swan It looks beautiful as it glides across the water, and that's the experience that you as the investor will have. But trust me, under the surface, there's some furious paddling going on, and that is what the active manager does for you. So I think final comment from me also, that this thinking that an ETF or an exchange-traded product necessarily means that you're only buying a so-called passive investment, long gone. We now have actively managed ETFs available on the JSE, and we've got a great range of actively managed certificates. So when you're ready to start thinking beyond stocks, individual companies that you're buying, there's a whole world waiting for you to explore. Thank you.
Thank you very much, Narina, for breaking it down. Yes, you may give a round of applause. You're welcome. Thank you very much. You referred to the total expense ratio.
Yes.
I would like for you to break them down for us, what it is, why is it important, but also mostly people will be used to tracking individual stocks.
Yes.
Chantal spoke about cheap stocks. How do we know what is the right price to get into an ETF, for example?
Great question, Langa. Thank you for that. So the total expense ratio is a term that unit trust investors will most likely be a lot more familiar with. That is the cost what it costs to actually manage that underlying investment portfolio on your behalf. So that total expense ratio gives you a sense not of the price of the ETF, but rather how much does it cost to actually put it together. And obviously, the lower that total expense ratio, the more of the performance of that portfolio is in the hands of you, the investor. You will see that all of the exchange-traded funds on the JSE trade at total expense ratios of well below 1% per annum. Some of these actively managed certificates start trading at somewhat higher ones because there's a lot more activity in it. So when you want to assess the cost effectiveness of an investment, it's not about the price at which you're going to buy it, but rather what is that total expense ratio. Understand that there are some that would be really inexpensive. The Satrix 40, 10 basis points. The Satrix capped all share that I spoke about, 15 basis points, 0.15%. But if you see something that is at a higher price, understand also when is it justified and ask yourself, would I be able to manage this portfolio of investments at a lower price or a lower cost than this portfolio manager does? And I think you'll not only have to acknowledge and admit, but find that no, you're not able to do so.
Thank you very much. Petre, over to you. Let's jump right into it.
Okay.
Looks like we have some
Nice
fan
to see
base
you,
here,
Brian.
Petre.
So, Bright Kamala from Vestact in the back there.
Yeah.
Right, so my stock picks are a little different. Slightly higher risk, and maybe not as popular with the ESG crowd as what most people are. We're backing the more dirty assets. So we're going with Sasol, Thungela Resources, as well as Anglo Gold. So where do I start? I suppose we'll start with Anglo Gold, just to reiterate, I guess, the importance that commodities has had on our economy. I think at some point the Anglo Group, before it was broken up into its various bits and pieces, sort of, pre the end of apartheid, it accounted for something like 20% of all of South Africa's GDP. One business, right? And that was all commodities and mining. Since then, it's obviously been broken up into little bits and pieces. And at the time, it was also about 60% of the JSE and 20% of the whole economy, right? So that's a massive business. Since then, it's been broken up into little bits and pieces. The gold mining business was spun out as Anglo Gold. Lots has changed in the interim. It now no longer owns any gold mines in South Africa. It's recently bought some stuff in the Northern Hemisphere as well, but it's essentially streamlined itself into I want to say, multinational gold miner ex-South African investments. There are some corporate actions that took place as well. I think on the 20th, Anglo Gold Limited ceases to exist and it changes into Anglo Gold PLC. So the primary listing has changed from the Johannesburg Stock Exchange now to the New York Stock Exchange, with secondary listings here as well as in other places around the world. And the reason that they're doing this, well, is really, I suppose, twofold, right? One, if you look at gold miners operating in the international arena, listed in South Africa, they're trading at about a 25% discount compared to gold miners listed on America, or on the American stock exchanges, right, or in America. So the rationale here is really that they want to try to unlock a little bit of value for shareholders, and they want to get a more fair valuation in a more liquid market and easier access to capital. So this is, to me, a bit of a value unlock play, if you will. Two, I'm quite bearish on the global economy at the moment. It's hard to be a bear when the markets keep going up, I won't lie. But if we are correct about our assumptions, what's going to happen over the next sort of 12 to 24 months, gold is going to be a good place to be, right? And geared exposure to the gold price via a gold miner, obviously the geared exposure there is the sense that if gold goes up, $10, the gold miners will go up 20% kind of thing, right? So because they're so geared to the price of gold, and they can generally contain their costs fairly well, all-in sustaining cost for Anglo Gold is something like $1,255 or $65 an ounce, with the gold price at about $1,600, $1,700. They're making a lot of profit, right? So as the gold price goes up, profitability goes up, and the shares react a lot stronger. So if the global economy does catch a bit of a speed wobble, the gold price catches a bit of a bid, the gold miners will do well. Plus, you have this restructuring of the business and the changing of the primary listing to a market where it's more liquid, and we might be able to unlock a bit more value. So there's already about a 25% upside, I would say, from just a re-rating or a revaluation of that stock in a new, more liquid market. And then also, we don't quite know, there are rumors, of course, and we don't know whether or not the deal will go through, but Anglo Gold could potentially be a target for a company called Barrick Gold, who is currently the world's largest gold producer, as a potential takeout. A lot of their mines are close to each other. There's a lot of synergies that could be formed between the two companies, and if that does happen and a bid for Anglo Gold does come, then the sky's the limit, as the saying goes. So it is a much higher risk play, right? As all my picks really are. But I do think that there's a lot of value, and there's a little bit of safety in the fact that this listing change is happening on the 20th of this month, and that should already start to unlock a little bit of value and maybe put a bit of buying pressure on the stock, at least in the short term, let's say, or the medium term, let's say, to the next 3 to 6 months, right? Moving on from that, we're going to Sasol, which is the stock everybody loves to hate at this stage. Even the government hates it. They're not getting water licenses. They're not getting... Secunda, I think, is the highest polluting factory on Earth, right? In terms of SO3 emissions. So that is really not a great spot. And I think one of the things that we might see there, and we saw their CEO making these comments as well, is that if they can't get that plant in Secunda to run more cleanly, they're going to have to do a phase shutdown. So it's not great, not really a great outlook for Sasol. Plus, they might have some challenges getting, one of their coileries might be losing its water license as well. So there's a lot of challenges for Sasol. However, if you look at least from our perspective, what's currently happening in the oil market, we have reduction of oil output from the major oil producers, Saudi Arabia, all the rest, OPEC, right? They are cutting production. At the moment, we do have the market very recently swung from a supply deficit, from a supply sort of surplus to a deficit, right? So we are in a bit of a shortage of oil situation, and we continue to see, support for production cuts from OPEC. So for the oil price, it seems that up is the way to go. Now, yes, the green transition is happening, and everybody wants to go green, and that's wonderful, and we're all just pushing the emissions further down the supply chain, really, because we're no longer, burning coal in Europe, which is also a farce, to be truthful, but we're moving those emissions further down the supply chain. Everyone wants to go batteries and this and that, but the poor kids in Africa have to mine cobalt, 24/7. So it's not actually as green as what we think. So the reality is that green energy is only really contributing about 2 or 3% to the global energy mix at this point, and oil and coal is still doing the heavy lifting. So truthfully, in the international arena, you could look at uranium investments, because I think that's really where green energy will have to go if we want to become sustainable. But in the short term, we have a number of things happening. We've got upward pressure on the oil price. We've got a winter heading we're heading into winter in the Northern Hemisphere. Now, they had a very hot winter last year. It's unlikely that they'll have 2 hot winters in a row. We'll talk about that a bit more when it comes to Thungela. So I foresee sort of higher energy prices in general, right? If you then compare Sasol to its international peers, so the energy sector in the US, for example, it's undervalued by about 30% in the sense that Sasol is down some 7%, while US energy sector is up 23%. It's very similar in Europe. In fact, the European energy sector is up even higher, while Sasol is sort of flat to down. And as well as other large-scale energy players, Sasol has very much lagged behind them. Now, yes, Sasol does have overhead challenges. However, from a shorter-term, more risky perspective, we could see Sasol playing a bit of catch-up if we see the oil price really continue to stay above $90, stay above $92. If it reaches $95, I think there might be a bit of a catch-up play for Sasol in the sort of shorter term. So 3 to 6 months is the outlook for this holding, provided that the company doesn't melt down. Although Sasol will survive, right? Even though it has its challenges, it's been around for a very long time. It's not going to go anywhere. And then the last pick that we have is Thungela Resources. Now, Thungela did extremely well. It paid a 60 Rand dividend. It was fanfare all around. And then essentially the coal prices collapsed. It was a nice hot winter, warm winter in the northern hemisphere, and they had a number of different challenges. One, the price of coal came down severely, and two, couldn't really get the stuff out of the country because there were some railroad issues, right? So let's assume that those railroad issues remain intact or remain the same, but there is, I think, hope for the coal price. So again, the green energy transition and all that stuff is happening. For some reason, Europe refuses to build nuclear power stations and continue to shut them down, which is, in fact, recommissioning previously closed coal-fired power stations, right? So they are buying coal. We see that Thungela bought, I think, an 86% stake in a Australian mining company. I'm not sure what the company name is. Esham, thank you.
Yes.
A real analyst.
No.
And I mean, they also do essentially coal from Queensland and Australia. So their production capacity is expanding. And I think what we are heading into is, even if it's not a cold winter on the scale, it might not just be as warm. So we have, I think, what's going to be an increasing demand for energy, plus a very stubborn Europe when it comes to uranium and nuclear energy. So a large amount of demand, I think, is going to come through for thermal coal. And let's face it, no one is better positioned to take advantage of higher energy prices, particularly coal prices, than someone like Thungela Resources. So that's, again, potentially a slightly riskier play. We're looking 6 to 12 months on that one to play out. I mean, I don't think we'll see another 60 Rand dividend anytime soon, but we never know. If coal prices did what they did during the initial stages of COVID and the initial stages of the Ukrainian invasion, if you want to call it that, there could be quite a little bit of upside. I'm not sure that energy prices will go that crazy again, but I think we are going to see higher sustained energy prices over time. And because this transition into green is taking a very long time and is posing a lot of challenges and isn't quite as efficient as what everyone would like to believe, coal is going to be around for quite some time. And until such time, Thungela is going to make a lot of money, I think.
Petra, thank you very much for those stock picks. So, and for pushing the risk curve a little bit. I have one question for you. When I listen to you, it sounds someone needs to be either an economist or a geologist in order to pick to pick these stocks. How would an ordinary person follow the news? There's so much to keep track of: price of gold, the strength of the dollar, global supply issues that come into the picture. How does one kind of follow all of these things? Because you need to track them in order to make decisions.
I can't remember the name of the author, but the book is called Intermarket Analysis. I can't remember the name of the author. If I think about it, I'll let you know. But essentially, it's a very helpful book because it sort of teaches you how commodities move the equity market, how bonds, fixed income move the commodity market, which in turn move the dollar, which in turn move the equity market, how the puzzle fits together, right? So that's a very helpful way to try to understand the puzzle, if you will. Other than that, I mean, the data is available. TradingView.com is great. MoneyWeb is great. The data is out there and available for you to find if you want to look at it. And what we try to do is really just observe the world and look at what is happening in the world today and try to figure out what we believe is the most likely thing to happen in future. And this is why, there's not a lot of uranium, well, there's no uranium options in South Africa, really. There was uranium one, but that was a con, right? So this is why uranium, for example, is something that we look at, because we look at the primary focus of the world at the moment is energy, and doing that in a green way. And what do we think is going to happen with energy over the next 50 years? We will transition away from oil. It will take a long time, and it will, but if you look historically as well, whenever a new energy source comes up, it is added to the energy mix. It doesn't replace a previous one. So when we were burning, whale fat, we replaced that one eventually. But, LNG gas came around, and then coal came around, and then this came around, and it sort of just stacks on top of each other. It doesn't really go away. So the only thing to remove fossil fuels from the equation is to find a more efficient way of doing energy. And we'd like to say that, cold fusion is something that we're working on, but we haven't got it right yet. So the only thing we really can say is fission, is nuclear energy, right? So that's the only sustainable way that we can produce clean energy. So do we think that this is going to be where the world goes the next couple of years? So now you start looking for data, and this is, good old-fashioned Google/news is amazing, right? And you start looking for who's making investments in the nuclear energy space, and you look at all the BRICS nations. Right? All the NATO nations are not doing it. All the BRICS nations are doing it in a big scale, right? So you start to think to yourself, okay, well, where does uranium come from? And so you follow this sort of theme. You observe the world around you, and you look at what's happening, and you kind of try to project what do you think is the most likely thing to happen over the next 50 years, and then from there you start following the rabbit hole. Where do I find opportunities? Where do I think, for example, another thing that Nerina and I were talking about a bit earlier, sorry, and I'm taking a lot of time here. Let's assume that almost 50, interest rates are really high in the US. So we know the impact of that, right? It's harder to get credit. The credit that you do have is more expensive to pay. So the chances of you buying a new car in this environment is relatively low, right? So in America, we would say that that's the case too, because, we're used to high interest rates because we're African, we're tough, but they're absolutely not. So they're sitting with record high interest rates, and everyone's crying and squealing, so no one's going to buy new cars. So who's going to be the winner here? Well, what's going to happen is you're going to have to hang on to your car for a longer period of time, right? Which means your car's going to need more maintenance, right? So auto parts manufacturers. So there's an idea for you to now go and explore. Now you can start looking for which companies in this sector, or potentially even an ETF. It's much easier than trying to pick individual companies. Then you can go now look around in that sector. Where do I invest, or do I just buy the ETF, or whatever the case is? So you try to find that theme, that thematic sort of structure of what the market is doing, and you just follow the rabbit hole and see if you can find a good investment from there.
Yeah, thank you very much. Remember the name of the book, Intermarket Analysis. We don't know the author, but Google will help you with that. So let's switch it up a little bit and take questions from the floor. Just so that we are orderly, I will take one per row. So I'll take one question. If I can just see the show of hands, there are roving mics around. I will start here. One, I don't see a hand there, so they're still thinking. There's a hand here, the gentleman in the middle. Yes, please. Let's start.
Ladies
there.
first,
We'll come back to you.
Over there.
Yeah, let's get the mic to the lady, please.
Hi, everyone.
Hello.
Okay. My name is Kelebocha. I am a sales trader for Tribe Investments. This question goes to Nerina. Sorry, I had to write this down so I don't forget. Okay, that's better. So what criteria or factors do you consider when selecting ETFs for investment? And how do you evaluate their potential for growth? Thanks.
I'm
Thank
so
you.
glad that Pietri gave us such a wonderful lesson almost in terms of how to identify potential investments, because that's exactly the type of process that one would follow. The majority of exchange-traded funds track an index. So when you're evaluating the investment potential of a particular ETF, you go to the index, because the index is going to tell you exactly what's going to be in your ETF, what's in your investment, and index information is freely and readily available in terms of not just what is currently in an index, but very importantly, what are the rules around choosing the investments that go into that index. So for me, that is my clue. I identify what is the investment theme or investment topic that I want to explore, and then to find an index that would give me that exposure, and then you find the ETF that tracks that investment. And the growth opportunity is exactly the same. Please don't make the mistake of looking at the past performance of that ETF or of any investment for that matter and think that that's going to tell you something about its growth potential for the future. It's all about what's in the underlying investment, what is the growth potential of that particular group of investments, and that's how you choose.
Thank you. Gentleman over here. No. He's hijacking that mic. There's a gentleman who raised his hand here. So, yeah.
I really need a cough.
Hi, my question is for Narina. Could you please repeat the name and code of your commodity certificate? And then if we look it up online, can we find a full list of holdings, or would we need to request more of that from the fact sheet?
Great stuff. So the question is around the name and the code of the commodity investment that I mentioned. It's the Coherent Capital Global Commodity Portfolio, and the code is CCM for Coherent Capital Management, GCZ Global Commodity in ZAR, in Rand. So there's the Q for the CCMGCZ. The underlying holdings, so an actively managed certificate, just like an ETN, is actually an investment instrument that is issued by a bank. So you're effectively buying a promise of the return of a particular reference investment from a bank. And in this case, UBS, Union Bank of Switzerland, is the issuer of this. So on the UBS website, they've got the full details of all the different AMCs that they offer. The companies also do issue fact sheets, so you do see what's available via that. But typically you'll find that they are very ready to engage and educate investors about what's in the investment so that you can actually make an informed decision. Thank you.
Thank you. Yeah, you may.
Okay. My name is Sakile Mamba from Seposa to Sambulu. I just had a question for Petri. You told us the advantages of a company changes, like moving from breaking it down and moving to the New York Stock Exchange. But what would be the risk associated with the same changes, such as breaking a company down into different segments and actually moving from the JSE to New York Stock Exchange?
Okay, I'm going to follow up with a question to you as well, just to understand your question a bit better. So, the advantages of breaking the business into smaller pieces and to change the primary listing to an outside sort of country. What are the risks involved with that? Am I understanding that correctly? Okay, so it depends, I guess, right? I mean, the risks are to us as South Africa, because we lose essentially the tax domiciling of a big company. We saw originally they've moved their head office to London already, right? So now they're changing the company from a limited LTD, which is a South African business, to a PLC, which is a UK business, right? So we're losing that business as a South African business. Now, they've already sold off all their mines in South Africa already, so you could argue that it's no longer a South African business anyway, right? But I think I suppose, more properly answer the question, we'll go back further in time. So it was Anglo Group, and Anglo Group then broke into Anglo-American, Platinum, and then Anglo Gold, right? And then over time, they've started breaking up into smaller pieces as well. I think Sibanye was a spin-off from that group as well.
Mondi as well.
Mondi as well, yeah.
Impact from Mondi.
Yeah, they were in
AVI?
everything, right?
AVI?
So
It was 20% of the GDP.
Yeah,
so
it
that
was-
those were from the days when South African companies couldn't invest offshore. So they just bought more and more and more of South Africa, and you got these huge conglomerates.
Yeah.
And so this is the unbundling.
So I think generally what we see in the market is that when companies break themselves into smaller pieces, it's either because one of the pieces is doing really, really poorly and dragging the rest of the company down, so they want to get rid of that, or they're getting so big that they're becoming inefficient. So it sort of breeds complacency and inefficiency. So you then break it into smaller pieces so that each piece is then, self-directed and run by itself and can become more efficient in itself. So in general, it's seen as a value unlock for shareholders, right? Like if you take Naspers, for example, it's probably maybe another good idea. Another good example, where they have one or two major investments that are, making an enormous amount of money, but there are other investments in the South African media business that are losing tons of money. So the Naspers share is being held back by the local businesses that are losing money. And, the value unlock comes from changing the structure so that we can re-rate the offshore stuff and the stuff that's making money at a fair valuation. So I actually don't know how to answer your question, if I'm honest with you, because I haven't answered it. So I don't know.
Okay. Thanks, Pietro, for that. There is a question over there. Happy to take that question. Okay, there's already a mic there, so let's start with you, sir. Please go ahead.
Hi.
You'll be the second.
My question is for Chantel. Master drilling and the likes, there's quite a few resource-associated stocks that just aren't performing.
Yeah.
Renogen's another classic example. All the underlying assets are in place, good companies, solid management, but yet they're still not performing. Can you give us some sort of rationale as to why you think that might be?
So
can I add to that question? Because I was going to
Yes.
ask the same thing. Master Drilling has been listed since 2011, I think, or 2012, December, and it's up 55%. And in that period, you basically lost money if you've invested in that. For
Yeah.
example, if I had clients and I invested my money or their money into Master Drilling, today I wouldn't have a job. So what will be different in the next 10 years if you invest in Master Drilling? And what's the opportunity cost to investing in Master Drilling?
So one of the reasons why Master Drilling is different to the rest of the commodity sector is that or mining companies, is that they don't actually have to get anything out of the ground. They have the technology and the equipment to drill the holes so that someone else pays to get stuff out of the ground. So they're a service provider, which means that they have more certainty of cash flows, and it's a lot more predictable than for a mining company. Also, to a certain extent, it's counter-cyclical. So when mining companies start investing heavily in capital expenditure, which they have to do over the next 10 to 15 years, Master Drilling gets paid, whereas profitability and returns to shareholders come under pressure when mining companies are raising debt to fund capex. And obviously those returns aren't coming through yet because they are still building towards that additional capacity. So it's almost counter-cyclical to a certain extent. Why Master Drilling share price hasn't performed well since listing? Firstly, there's definitely a free float issue, and we have raised this with management. A free float issue means that they actually own too much of their own shares. The founders own too much of the shares, and there's not enough shares floating about so that price can adequately kind of reflect the underlying fundamentals. If you look at the share price, it also doesn't reflect the growth in earnings that we've actually seen, nor the shareholder returns. So I think that it's an opportunity more than anything else. And what's changing over the next 10 years is we are definitely not going to have another capex strike from the mining companies. At some point, they have to start investing. They can't meet demand for a lot of these critical commodities. And their mines are becoming less efficient, they are mining less, ounces are coming down. They have to survive, they have to invest. So they have to drill holes. Master Drilling.
Could I add to your answer, Chantal?
Yeah.
I think what we have seen over the last couple of years is a severe reduction in liquidity in the JSE. So there's just not a lot of people trading, right? And that leads to situations where things are mispriced. Now you add on top of that a situation where the shares are very tightly held and there's not a huge amount of free float. If you're a fund manager, Bright, for example, let's say you've got to buy 25 million rands worth of master drilling. How do you do that? There's no liquidity. So these smaller companies are often completely mispriced. Like if you look at someone like Jubilee Metals Group, for example, I think Jubilee is a great business. But the liquidity in that is really hard. So if you're a big fund manager and you've got to buy this stock, it's very difficult for you to do that because you're going to move the share price 200% in the process. So you just avoid it. And that means that we have these pockets of completely undervalued smaller cap companies where there's a lot of value to be had for private investors.
Thank you very much. We are going to have to close it there. For those online, we will be able to continue here just for a short while. But for now, thank you very much. You have been a wonderful crowd. And may we please give a round of applause to our wonderful panelists here.